Hello and welcome to a brand new show of Market Makers. Well, we are back after a break and we are back with a special guest. The bedrock for the market needs no introduction. What was supposed to be a dull year so far has turned out to be a dream year for Indian equity markets. Both on an absolute term and on a relative term, for the moment, India is the toast of the town. But where do we go from here? There is enough and more talk that Indian markets are completely dependent on local and global liquidity. Is the local liquidity here to stay? And more importantly, what about margin of safety and asset allocation in this kind of an environment? To discuss all that and much more, I have with me the perfect guest, someone who needs no introduction whatsoever, Karan Bhagat of IIFL Wealth. Fantastic to have you back.
Thanks, Nikunj.
At the beginning of the year, we talked about the need to allocate more towards equity.
That's right.
And the call so far has been right. Equity has given what could be called as a dream return so far. Where do we go from here?
Well, I think when we look at equity, there are two or three macro trends we'll need to kind of consider. And I think one of the key things which has happened in India especially, and I'll come to the global flows later, over the last 6 to 12 months is a big shift in the way Indian clients are investing their savings. Traditionally, if you go back 3 to 4 years, the three predominant asset classes were effectively real estate, gold, and fixed deposits. These three were the possibly the three bedrock of investments, and they occupied a good chunky 60 to 90% of every client's portfolio. All three have gone through their own challenges over the last 3 years. Real estate has been not seen any massive correction, let's say in places like Bombay. In Delhi, the prices have kind of come off in certain specific regions. But otherwise, at best, the rates have been more or less flat at an headline level. And in a country where 6 to 7% is the broader inflation, flat prices really don't help over a sustained period of time. Gold is also not really moved anywhere. It's been in a pretty much similar range in rupee terms between the 27, 28, 29,000 kind of levels. And in addition, fixed deposit rates have come off very sharply from the earlier 8.5%, 9% now to the 6, 6.5%, 7% on a post-tax basis, possibly 3.5%, 4.5%. So all these three have left investors with very little choice but to look beyond these three set of investments. Aided by this has been essentially a I think sustained effort by all of us advisors, by the regulator, by people like yourselves to educate people about investing in mutual funds, whether it's equity or fixed income. And that is also bearing some results over a longer period of time. And the third and most important thing I think which we need to consider is the fact that investors have started kind of allocating a small portion from their monthly earnings. Last month there were 1.3 crore investors who came in with an average of 3,950 rupees into SIPs. Now SIP is coming out of the monthly paychecks in less than $60 is a very, very sustainable amount, and it's most likely to continue and stay. Recent statistics have shown that there is a net addition of SIPs, which means newcomers versus old people who have stopped paying, nearly to the extent of 2.5% of the stock. So if there's currently 1.3 crore SIPs going, the industry is adding nearly 3 to 4 or 5 lakh SIPs on a monthly basis. Effectively, if you extrapolate this number over a 1 year basis and the broad investment climate continues to be positive, this number might go from 1.3 to 2 crore people, and if the average even stays at 4,000, you suddenly got an influx of 8,000 crores per month coming into equity funds. Now that by itself is just a number, but it's a very important counterplay to the markets being extremely volatile due to FI flows, which in turn might be driven not only by domestic conditions but a lot of other global factors also. So I think one big change which is helping liquidity and not necessarily valuations, because both of them are may always not move together, is that there is a definite shift in the pattern of domestic savings. I think the second thing which is helping in a big way is the demonetization exercise in some ways. I think people have become used to a more formal economy as opposed to an informal economy, and therefore the need to invest the money formally and have immediate access to it as opposed to give unsecured loans and so on and so forth has become more an order of the day as opposed to what it was.
They're happy to pay tax rather than keeping the money close to the
heart. And it's something which is they're more comfortable with. I think a second important change along with demonetization which has come in, and I think it's gone slightly unnoticed, but I think it'll pick on as time goes by, is this introduction or reduction of corporate tax rate to 25% for below 50 crores of revenue in this budget. Now that's a big one, not for let's say corporates or even large corporates or even mid-sized corporates, and especially in the listed space, everybody will have a revenue more than 50 crores. Most people would, but the massive change in space is basically in the professionals and the unorganized SME market, because if you today see movie stars, actors, professionals, chartered accountants, corporate lawyers, all of whom possibly do extremely well and are outside the salary tax net, okay, but are having revenues, let's say somewhere between 50 lakhs to 50 crores. They typically were possibly not fully in the formal channel, but now with a reduced tax rate of 25% and the ability to actually create a sole proprietorship or a partnership kind of structure and able to set off their expenses as well as account for the revenue, and then on the net basis pay 25%, is a very, very powerful exercise as opposed to staying in the informal side. So I see, and this could then extend to a lot of retail shops and everybody, right? A retail shop with 15 small retail stores would want to come into this kind of a formal economy, see able to set off his expenses. He can set off his car depreciation, he can do all of that provided he's able to account for it and pay 25%. So I think that is something which is again very, very powerful, and I think from a tax net perspective, I think salaried individuals are obviously well captured. This is a big segment in our country which was not possibly formally captured. I think this money will also come into the formal system now, which again will kind of spur up investments in some ways, because as the surpluses become more and more formal, the money has to find its way into financial instruments as opposed to unsecured forms of investments. So I think both these act as a very strong or serve as a very strong tailwind for financial savings in India. Globally, I think the picture from a US perspective obviously is kind of a 50-50 scenario. There also tax rates are expected to go down, market kind of is factoring it in. Earnings has been decent there, valuations are close to all-time highs, but again it's very liquidity supportive, driven by a fairly accommodative central bank policy over the last 4 to 5 years. So globally also I think unless there's a massive shift, we don't see a big aversion to India, because even if you look at the entire globe today, with a little bit of specter on China, India continues to be one of the favorite destinations to come into.
Yeah, this is a Goldilocks scenario.
Yeah, it's a Goldilocks scenario, especially in terms of the emerging markets. Brazil's got its own set of problems. Russia is interesting but a little opaque. China is again interesting but a little confusing, and then you're kind of left with India, where liquidity is also decent and the broad macro tailwinds are positive. So I think from a liquidity perspective, markets are set aside well. Valuations, obviously we can kind of go to that, but valuations are definitely not cheap, but they're definitely not in a bubble zone. Okay, so last 5 years earnings has been less than 2% compounded on a annualized basis. We've got margins which are not at historic highs. We've got capacity utilizations which are still not at historic highs. So in case of a pickup in demand, I think the operating leverage for most companies is fairly decent. I would not be wrong to say that if we see a 7-8% pickup in demand, we might actually see a 15-20% growth in.
The mean revision really is
going to be quite high. So, for example, Bloomberg, I think consensus estimates earnings for this year is around about 475, 480. If we actually end up at 480 at around about 9,400, we are 19 and a half, 20 times forward earnings. By no stretch of imagination cheap. But by no stretch of imagination absolutely out of...
and this is the new index where there is no...
There's a new index, absolutely.
Commodity, there is more of consumption, more of names like Aisha Motor, which are otherwise expensive stocks.
So we are towards the top end, but I would possibly say 16 to 19 times is the real long-term mean, somewhere there, depending on a lot of other variables. But at some point, so I think we are not massively skeptical about valuations. I think liquidity will support it. Needless to say, there will be corrections. Okay, so there will be corrections. Liquidity in, out, little bit of leverage here, there will cause some bit of corrections, but it'll get evened out. And sometimes corrections are deep, fast, very difficult to get out. And even if you get out, and you feel good about the fact that you got out before the correction, you need to feel equally good about the fact that you came in before the reversion started. So in these kind of markets, you don't only need to get your exit right, you also need to get your entry back in right. And actually sometimes getting both of those right become really difficult. So sometimes it kind of makes a little bit of sense to take a 3 to 5 year view and possibly stay invested. So I think that's the broad call.
Okay. Now between us boys, the way financial investors pitch equity to their clients is that you should expect early double-digit return from these years.
Yes.
Now the early double-digit return has come in this year itself. Yeah. So if you bought into stocks, whether it's a small cap index or a large cap index, you've already made your 14-15% return.
You mean from January?
From January.
Yeah.
So somewhere is it time now to book out some profits or stay on course?
So as I said, I think very difficult to, so let's assume you made your 14-15% from January, right?
Yeah.
And let's assume you came in at 8,700 or whatever that level was, or 9,000, whatever that level was. Now the point is, let's say you book your return and you're successful, and let's say the markets come down to 89.50. Okay. At 89.50, what is the probability, or what is that level at which you'll reinvest that money? And what if the market does come down to 89.50, but over a 3-year period ends up at 11.5, 12,000? Then this 14-15% which you made for the first 6 months will look fairly irrelevant, because you would have lost the opportunity to make for the next 2.5 years.
So stay on the course.
So I think stay on the course. It's extremely, so unless you are either a
great market timer,
either great
really
market timer or God's gift to mankind, or it's next to impossible. I can't do it personally. I don't
no one can
so.
do it.
No one can do it, right? If any of us could do it, we would be multi-billionaires. But it's not possible, and therefore I think to enter and exit for small corrections of 5 to 7% may be very, very difficult to plan out over the next 2.5, 3 years. I think clients need to focus on the allocation of how much they want to invest in equities. What is that quantum which will not make them nervous if the markets go down 5-7%, and accordingly invest, rather than focusing too much on trying to make either quick returns or trying to make quick exits and re-entry. I think both will not work. It's better to focus and get an allocation right. Across our client base, I think if you go back a couple of years back, we were possibly 30-70 in the or 35-65, 35% in equity, 65 in fixed income. When I was in your channel last, I think a year, 6 or 7 months back,
yes.
It had shifted to around about 40-45% equity. Today, possibly on an aggregate, it will be around about 50-55% equity, 45-50% on the
Will that change more?
I think it'll go to about 60 for sure on an aggregate. Okay, 60% equity and 40% fixed income. Will it go towards like 70-30? I think in some client portfolios, yes. But on an aggregate, I don't see it going beyond 2/3, 1/3 in the longer term.
So what I'm trying to gather from you is that you're making a case that it is still time to buy risk.
Yes, it is time to buy risk, but it depends on how much you're already allocated. In the sense, if you're already allocated 55-60% and you want to come to 65% of your portfolio, or to make it simple, let's say you already allocated 90% of what you want to allocate in equity, then the remaining 10% you might want to sit out and see if there's some kind of correction, and you put in the remaining 10. But I don't think so. It's a massive time to sit and say that I'm going to wait for the mother of all corrections and then come in. I think that's really going to be very difficult to time. I think we would broadly stay invested.
Now there are two sources of liquidity. First is the shift from fixed income or real estate to gold into equities, and second is the first timers are making a comeback. So what's your sense on both?
I think both are here to stay. I think, see, first timers, again, as I said, there are no options now. It's very difficult to earn 10% on your money. And let's not forget that the government's given a big fillip to equity by making it tax-free after a year, as opposed to now debt mutual funds which become tax-free only after 3 years. So effectively there is also a big play in terms of tax. When you look at equity returns, they become post-tax. Yeah. When you look at fixed income returns, they become pre-tax. So any instrument which is giving you 9% return in fixed income or 7% return in fixed income after a year becomes fully taxable, and therefore post-tax return drops substantially. So all put together, I think even for the first timers, there is a very good case to be invested in equities. There will be a time when you may have to kind of take again strategic asset allocation calls back, but I don't think so. That's the time now. I think if you go back to 2007 also, we are well over 24-25 times in terms of forward multiples. So I think yes, the markets are discounting at least 1 year of forward earnings for sure, and it needs a 5 to 7% pickup in demand. But the larger things more or less seem to be in place, and obviously things look better when liquidity is so good. So, and exactly market down 400 points, people will say differently. But I think over a 3-year cycle, we believe there is double-digit post-tax returns to be made from equities.
You're telling your clients what not to buy.
So what not to buy, I think we do see a little froth in small caps and mid caps. Okay, there's a lot of companies quoting at 50, 60, 70, 80, 90 times a P. I think we would be a little cautious on those. Some of those stories may play out, but may take a longer time to come. And everything is about risk and return. So the return, in a sense, a lot of the future earnings have already kind of captured in, and the risk in case the earnings don't play out is not fully justifiable. So if you have a possibility of stock giving you 50% upside but falling 50%, that's not a trade we want to do, because the risk return is not really in our favor. Contrasted to that, let's say a stock like HDFC Bank, hypothetically, it still might be expensive at 4.5 times book, but if you look at the entire banking space, and if you were to see a recovery in the credit cycle, there will be only a handful set of large banks which are having the ability to expand their balance sheet very quickly and effectively. And in case growth was to come back, in spite of HDFC Bank, let's say, being a little expensive, it's still possibly set out to deliver the highest amount of absolute growth in some ways. So I think in some portions we will stick to quality, and in some sectors definitely it's not only about picking up the right small cap or the mid cap stock. I think it's also about the big becoming bigger, because the nature of the business requires you to be big in some ways. So I think today most of our portfolios are tilted a little towards quality as opposed to a huge amount of growth orientation. We believe that as if and when demand picks up and capex cycle kind of turns around, there will be two kinds of companies. One kind of company which is recovering to recover its losses and therefore gets repositioned and repriced, and the other one which benefits because of a strong balance sheet out of the growth. We'll prefer to be in the latter as opposed to being in the former.
Makes sense. I mean, that's how all the convergences.
Yeah, so we want to buy the growth. We don't want to buy recovery in that sense of recovery of balance sheet.
Now, your business started more like a boutique venture a couple of years ago. Now you've become a powerhouse.
8 years, 9 years.
9 years ago.
No, 9 years, yeah.
9 years ago. It was almost like a boutique offering, and now you've become a very large powerhouse. So what I want to understand from you is that as you're growing, where is growth coming from?
So I think we start. So I'll take it back 9 years. So we started as a professional entrepreneurship firm in some ways. So we're professionals. IIFL is obviously a large listed company already, and we kind of got together to start this off. But I think growth is coming out of three things really. I think one, our biggest growth has been new money to the market, okay, as opposed to necessarily moving existing assets from other private wealth firms to ours. And new money is largely a function of three sources. It's essentially entrepreneurs who are exiting their businesses because the second or third generation doesn't want to come back into the business, and possibly the ROEs of the businesses are now in early single or early double digits, which in terms of risk return is not justified by the appropriate risk-free return.
They'll have to put in more capital, which is not worth it.
So as soon as you want to pick your ROEs in the business from 11-12% again back to the 20s, you need to put in more capital, you need to modernize your plant, and if your second generation not coming into the business, you don't want to get into that cycle again. So possibly consolidating it into a larger player makes more sense. And with the consideration you get, the post-tax return on a blended basis is possibly working out slightly more attractive than continuing in business. So a lot of small, medium enterprises, there is a little bit of consolidation. So this in some ways is new money into the industry. Sale of land is a big source of capital. And third, very interesting has been sale of stock options and stories very similar to ours, but basically in financial technologies, technology, especially in fintech and technology, has been very large over the last 15 years. Because technology, from a definition perspective, saw ESOPs all the way from late 90s. And fourth, obviously, is your new gen kind of startup exits. Those have not been many, but there have been 10 to 15 material exits. And there also, I think we've ended up getting a good market share. And lastly is the old age industrialist who's kind of built his own distinct portfolio outside of his business through dividends over a long period of time. So these five basically are the ones who are kind of adding new money to the industry as a whole. Apart from that, obviously we have corporate treasuries, which we don't engage with that much on a daily basis. But the first five segments are essentially which form the core of our.
Your business is built on trust and track record,
right.
And that's where I think the word disruption also has kicked in. There are robo-advisors. There are now websites which say, look, we charge you less and we give you the correct analytical advice. Is that the threat for a business like yours?
I think I don't want to not call it a threat, okay, because it's not. I think it's not wise not to call anything a threat. Anything in this world can become a threat. But I think world over, robo-advisory in ultra high net worth space has not been very if I can put it, very successful. I think Indian clients, by definition, not only Indian clients, I think Asia in general is a market which finds it very engaging to deal with advisors directly. Most of our clients are first generational. They made the money themselves, so they are commercially very smart. They like to meet their managers very often and take decisions. So I'm not sure whether robo-advisories in terms of decision making and client interaction will override, let's say, a channel like ours. But there will be a lot of disruption in execution. Okay, so I think digital disruption will be there. But I think in our business, process disruption and therefore productivity will be defined by the digital disruption as opposed to the actual decision to invest or not to invest.
The entire spectrum of things is very little. Debt versus equity, which is a good mutual fund, which is a bad mutual fund, that's standard stuff.
It could be anything. See, at the end of the day, delivery is not a combination of the final product. It's a combination of people, platform, products, okay, and processes. All four need to come together and you finally see the product in shape. What the client or let's say competition might eventually see is the product, but it's a very unique combination of all these four. And sometimes very difficult to define these four. It's more a culture issue as opposed to a straight line definition. But to your point, yes, we are not inventing, we are innovating. Okay, so those are two classically different words. And inventing, we are not scientists, we are not smart enough. Innovation can happen on anything. It could happen on timing, it could happen on fees, it could happen on asset class, it could happen on just a new idea. For example, we recently launched a fund which is focused on pre-IPO opportunities and opportunities where we are able to participate as anchor, or as an alternative investment fund you get qualified as a QIB instead of a high net worth. Now a lot of the quality issues, high net worth categories are getting subscribed by 300, 400 times. QIBs are getting subscribed by 50 by 60 times. You can also have the ability to possibly come in as an anchor. Some opportunities you get like in the pre-IPO. For example, we did RBL and Ujjivan last year. Okay, in one of our similar funds, and both have worked out extremely well. RBL has obviously moved from whatever 200 to 550. AU is we've got Ujjivan moved out from 200 to around about 350, now around about 310. But whatever it is, so basically we are able to see these kind of opportunities. I think that fund got a great response from clients. You get a good fee structure which is very, very competitive. It's an idea which is superior and not easily accessible by the individual himself. I think it works. I have funds collected around about $300 million already. So it's a good new. So this is just an example of innovation, and
you just have to innovate in the same space again and again.
And I could we could possibly discuss 2 a quarter for the last 9 years, but and then it has to become a habit as opposed to something which is to be forced down.
Okay, but just to wrap up today's lovely interaction. For someone who's a long haul guy, and when I say long haul, the definition of long haul in India is not 20 years, it is 2 to 3 years. You would say put money to work. This is not time for capital production. It's time to take that risk.
100%. I think there's no doubt about it. I would just caution by saying it is going to be accompanied by volatility. But volatility is a part of life, and put in that much money to risk where at least 10 to 15% of that on a mark-to-market basis will not kill your sleep.
Well, appreciate your time, and thank you for
Thanks,
joining
Prakash.
us.
Thanks.
That's it on this edition of Market Makers. Thank you for tuning